Hello and welcome to the Taxes Declassified webinar on the rising tax risk in retirement. My name is Chris Marsico. I'm happy to be with you today. I hope you all are doing well. Like I said, my name is Chris. I am from Marsico Financial Group. I am the current president of the firm. The firm was started back almost 50 years ago. Next year, we'll be celebrating our 50th anniversary, so we're very excited. My father started the firm. What we do here, we're just located north of Pittsburgh, about a half hour. We specialize in tax planning and financial planning. We kind of do our best to mirror those two together, merge them together, I guess is a better way to say that. And that's what we're talking about today. We're talking about taxes and how they can affect your retirement income because it's becoming more and more of an issue. We've seen it with a lot of our clients. So we want to make sure that everyone can do whatever they can do. We can help to minimize the taxes on your investments. Today's talk should only be about a little over a half hour. The way this webinar is set up, that we really don't have microphones on for anyone or video on for anyone, so no one can see anybody. So if you're enjoying a snack, don't worry, nobody's going to see you. And then you can ask some questions in the chat if you'd like. They would go just to us. We'll do our best to answer them there. If we don't get to them all, which is normally the case because I'm trying to present and answer questions, if we can't get to them all there, we will respond to you later on, or we'll figure that all out. So feel free to ask questions through the chat if you want. What I'm going to do for this presentation is I'm actually going to, you see me in a little box and you see the slides. So I'm going to minimize me. We don't need to be looking at me this whole time. We will focus on the important stuff, which is what the rising tax risk is in retirement. All right. So, as my teenage twins say, let's kick it. So today we'd like to discuss taxes, particularly how taxes may potentially impact your retirement savings approach. As you're on your path to retirement, there are certain things that you may focus on. One of those things I think a lot of people focus on is growth, right? When we talk about growth, that's what most people will focus on. Most people want to know that their investments are protected and saved, and that they get a decent amount of return, but they also want to offer some protection. That's very common. We see that a lot. What we also want to focus on today, even though growth and protection is very important, it's not the only thing that's important. Taxes are very important to consider in this path to a successful retirement. And that's because many people have saved all or majority of their retirement funds in what we call tax deferred vehicles. So a 401k, an IRA. These are typically vehicles that you have not paid tax on yet. And we wanted to kind of focus our conversation on that, because if taxes change anytime between now and when your last dollar is spent out of one of those qualified retirement accounts, it could impact the amount of money you receive in retirement. So we're going to start off with a simple illustration. But you know what? Actually, before we do the illustration, I'm going to actually post a little poll question. So we're going to post this question. You have some time to answer it. It just, which of the 5 potential tax risks is your biggest concern? So, what are you worried about when it comes to retirement and taxes? Just so we can kind of keep up to date with what's going on. All right. I think, take a couple seconds. We have some answers coming in. Perfect. All right. So moving ahead. So let's get to this 64-year-old with $1 million in IRA money, and he wants income until age 100. So let me kind of throw some stuff out there first. This is purely an example, an illustration, a hypothetical, whatever you want to call it. We're not saying that this is a recommended portfolio for you. We're not saying this is normal income you can get. We're just saying, given these parameters, how much income can we expect to get? So let's just see. So this person has $1 million, who's going to do a 50-50 portfolio, which means half is going to be in equities, which is stock, and half is going to be in bonds or fixed income type vehicles. And let's assume that this person has an effective tax rate of 20%. So what does that look like? So that gives you $50,000 in annual income. And over the life of this person to age 100, again, for purely hypothetical reasons. But now let's just say that the equities, for some reason, don't perform 1 year at 8%. We know the market has its ups and downs. Let's say that the equities actually only earn 5%. What does that new annual income look like for this particular hypothetical client with equities dropping to 5%? Well, it means their annual income is going to go down to $42,000, down from $50,000. So what, a little less than a 20% drop just because equities drop their performance. That's pretty standard. Most people know we got to try to protect against loss and market risk. I would imagine if you have a financial advisor, that's the bulk of the conversation, how to mitigate on this side of the equation. But what I want to look at is a little bit something different. What if the tax rate were to change on this person? If everything else stays the same, but the tax rate changes, what does that look like? Well, let's just say hypothetically that the taxes rise 30%. Let's say they go up 30%. And keep in mind that 30% number. We're going to get back to that later on the test. Just kidding, there is no test. But keep that in mind. We are going to talk about 30% here in a little bit later in the presentation. So what would that do? If taxes go up 30% to this person, how much income do they lose, gain, whatever? Actually, they're going to lose almost about the same, $43,000. So all I want to show you here is, I'm sure you've thought a lot about if the market goes up and down, what that's going to do to my retirement income. But I wonder, and I think probably some of you haven't really thought about, what happens if taxes change? What is that going to do? So that's why I just wanted to show that, a simple change in the tax rate can have a big impact on your income. So that leads to the question, where are tax rates heading? What is going to happen here? Because we know taxes can have an impact on retirement income, but let's just consider where they're heading. So there are three things that can happen to your taxes in retirement. This should not be a surprise to anybody. They could be lower than they are today. They could actually stay the same, or they could be higher than they are today. So really, what's most likely for you? Well, when we look at them changing in your particular situation, we got to look at a situational aspect of it, because that could impact your taxes without really any tax law changes or anything like that. When I say situational, what I mean is if you're married filing joint or single, that changes your tax consequences. If you need more income 1 year or less income in another year, that will change it as well. So when I say situational, I mean it's stuff that happens to you and you personally. So some people believe that these situational taxes are how their taxes could be lower than they are today. And the idea behind that is really an idea behind the tax deferred savings strategy, that your tax bracket could be lower today in retirement than it is today. So that's probably why most people choose to defer their taxes, because they believe taxes will be lower in retirement. But will they be lower in retirement? A lot of people, when we talk about the greatest generation, we obviously talk about what they did for this country and all those wonderful things, but we actually don't talk too much about what their retirement looked like. And if you think about how the tax laws changed drastically in the 60s, 70s, and 80s while these people were collecting income. So what a lot of them did is they may not have traveled as much. They may not have eaten out as much. They were able to reduce their lifestyle in retirement to provide for enough income to live off of. But really, how likely is that for now? How many people can sit there and say, yeah, I will use less income in retirement than I do now? If you want to maintain your lifestyle that you're currently living, even if your retirement plan is just to live about the same and just travel to see the grandkids every now and then, nothing extravagant, would you still need to maintain your normal everyday income, the income you're collecting right now? If you think that, yeah, it's going to be close, then you may be in the same tax bracket. And I've noticed a lot of clients that we work with end up pretty close to where they are in their income before or after retirement. So for some savers, their taxes could stay the same in retirement, just as they are today, because there wasn't too much change, right? But we've discussed that they could be lower. We've discussed they could stay the same. But honestly, could they be higher? And one of the ways we think about could they be higher is we look at different risks. And one of them is legislative. I kind of blew through that slide pretty quick there, but that's okay. We can keep moving forward. One of the risks that could make your tax bite higher is what I call legislative risk. Legislative risk is simply the risk that changes when Congress changes tax laws. Now, we know the new tax bill just passed, back in June or July, and it kept everything the same for the time being. They say it's permanent, but we all know when Congress says permanent, they mean until the next administration or what's on the chopping block lately. So a lot of people, experts, believe that taxes could be higher in retirement because of legislative risk in the future. Why is that? Well, it's easy, right? Our federal debt is over $30 trillion right now. So, with a debt that high that is continuing to grow, what does that mean for taxes? Well, on the very basic level, one of the easiest ways for our government to pay down the debt is to collect taxes, right? So they would, one of the tools in their toolbox is that they could raise taxes to get control of this federal deficit. Because as we all know, Congress is debating and spending trillions of dollars in their bills and their tax codes that they're going through. It seems like almost at the end of every year, it's always this debate, and they're talking about trillions of dollars that they're spending on us. Now, remember, I've saw this. I remember when this came out, and I see it every now and then that the politicians say, "Hey, no one making under $400,000 a year will ever have their taxes raised." Do we believe that? I'm not one to judge or say, but there are ways that taxes could go up regardless of your income level. And, I'm going to talk about 3 of those ways. So there are 3 ways that taxes could be higher the way I look at it. One of them is obviously the easy one, the brackets. They can always change the brackets. Right now, because of the tax law change that just happened, we know that the brackets are staying the same. And when I say brackets, what I mean are the rate in which you pay based on your income, right? You make between this much and this much, this is how much you pay in tax. So those brackets, but they could go up, they could go down. We know now that they've been extended, which is great, but are they always going to stay extended? Because don't forget, like we just said, there's $30 trillion that could be, that is added to our debt right now as a country. What's the other way that we can raise taxes, or taxes, not us, right? It's our congressman, but one of them is they can change the taxation of deductions. We all know married couples have certain deductions. We all know that you can get deductions for Medicare, childcare, home interest, mortgage, things like that. And then I always, tell people when they ask my opinion, when Congress goes to raise the taxes and they use the brackets, the last slide, that's very public, right? Within minutes, everyone would know how their congressperson or their senator voted for that. But when you change things like deductions, they don't usually get a lot of notice. So this is a tool that they have that probably wouldn't draw a lot of attention much past a couple days or something like that. Another way that I always think of when they could possibly change taxes, raise taxes, which is probably most likely, is they can always create new taxes, right? Congress has the ability to create new taxes. Things that weren't taxed before could be taxed now. A prime example is Social Security. We all know Social Security income is taxed at an 85% of it, the benefit. But what if Congress were to wake up and say, you know what, let's raise that to 100% of everyone's Social Security is taxed. So where does that leave us, right? That leaves us with needing to have a conversation about legislative risk. And it's a concept that I define as the idea or acknowledgement that Washington can change legislation, pass new legislation that impacts your future, impacts your retirement approach. And that's one area that we believe savers want to consider when structuring their strategy. They want to consider what possibly could happen to taxes in the future. And one of the important things that I have noticed that a lot of advisors even don't pay too much attention to, so we kind of focus on this a lot when we work with our clients, is what I call the micro side of it. When you talk about taxes, micro is like the very short term, right? So you have, this year, next year, this is what's going to happen to your taxes. We know what the tax rates are, so here's your tax rate. Great, no problem. But what people fail to do is consider what I call the macro side of it, because you aren't retired, hopefully, for just 1 or 2 years. Your retirement could last 10, 15 years, right? So you have to account for what could possibly happen to your taxes and your, by default, your income over the next 10, 15, 20, 25 years. So it's important to do what I call a macro analysis, right? And I'm going to show you one way that we analyze potential taxes on clients using the longer term approach, the longer term macro approach. So we're going to do another hypothetical here. Now, again, this hypothetical is not a recommendation. It's just to show you, based on these parameters, what taxes in the future could look like in this particular case. So in this case, we're working with a 64-year-old. Let's just say her tax liability is 25%. Let's say she has a $500,000 IRA and it averages a 5% annual growth. Pretty standard stuff. Again, just using this as hypothetical numbers. So what are the potential taxes this person could pay on the IRA of $500,000? So that's the total IRA amount. Well, when they take that money out as an RMD, which we all know is required minimum distribution, they'll pay tax on that. So that's one of the ways that they'll pay tax. What is another potential tax that they could pay? They could end up paying money on the taxes after they move those assets out. If they put those assets back in a growth type of investment or like a CD or something where they're gaining interest, you could possibly pay tax on that growth after you've already paid tax on it coming out. And the third way is, let's say you have some heirs that you want to leave the money to. You want to leave it to a charity or your children or whatever. They would pay tax on that IRA potentially as well. So those are the three main ways that I think you could be taxed on this IRA. So given these parameters of the tax liability of 25% to $500,000, what do each one of these taxes look like based on the IRS rules that we have right now? So the first one, the RMD's rules. Oh, yeah, obviously we want to total that up. All right, so the RMD rules is $204,000, right? You could potentially, over the lifetime of this account, pay $204,000 as RMDs. You could also pay an additional $96,000 as you move these assets to something else. And that could be a capital gains tax or a different type of tax, but hypothetically, it could be this amount. Then your heirs are stuck with paying some tax as well, potentially. So you can look at that. It's about another $156,000 that they would be exposed to. So in this hypothetical situation, what's the total taxes paid? It adds up to $456,000, which is no small number in my head. So anyway, that's kind of the doom and gloom side, right? What can we do? Well, you could potentially look at converting it to a tax-free account. I'm going to use the Roth IRA as an example here. There are other types of tax-free strategies that you can look at. This is just a very basic one that we use sometimes to help clients, in addition to a little more, I don't say complex, but a little more ways to work with other strategies. But the one for today's conversation, we're just going to talk about a Roth IRA. So let's look at what happens if we were to take that IRA that we haven't paid tax on and convert it to a Roth. So obviously when you do the conversion, in this case, we're keeping it simple. We're saying we're taking all $500,000 and dumping it into a Roth conversion, only for illustration purposes. It's not a recommendation, but let's just say you pay tax on there, and then we know you could potentially pay tax on what it grows, and you could potentially pay tax on what it looks like when you pass along after you pass. So let's look at these numbers to see what they look like. Total taxes paid on the Roth conversion, the first one, would be $125,000 potentially that this person could pay at the Roth conversion. So then we're going to want to add in how much they would pay in tax on the growth of a Roth IRA. 0. Yes, that's correct, right? Because as you convert to a Roth, you won't pay tax on it as it grows. So that you don't have to worry about that one. What happens to the Roth IRA and how is it taxed at the time of death? Potentially your tax liability there to your heirs would also be 0. That's the beauty of this conversion. So what is the total number of tax we paid? This is simple math. I can even do this one. $125,000 would be the potential total amount that you would pay by converting over to a Roth. All right, so you could face a choice, right? Based on these assumptions we just talked about. You could possibly pay $450,000 over time in taxes, or you could consider only paying $125,000 if in this scenario she converts it to a Roth IRA. Keep in mind, I haven't given all the details, benefits, requirements of either one of these strategies in this conversation. We're not doing that today. I'm just using these as examples. So the next question comes up, and we kind of talked about this earlier, is what happens if the taxes change? What happens if taxes go up or down? Obviously, in this scenario, we're going to look at up because that's the more challenging one to look at, the one we need to plan for. Because if taxes go down, which we don't think is very likely, I don't think anyone believes that is a really possible idea based on the trillions of dollars that we're in debt, right? So, let's talk about what happens if taxes change in the future. And here's how we approach thinking about it. We look at the middle tax person, in the middle population. What does that person pay in tax average, right? So we know the middle quintile, thinking back to our time in statistics in high school and college, we know that back in 1998, the middle quintile, the middle person in the United States, paid 28% in tax. That was it. That was the rate. Then in 2018, it's 22%. So we can see there that it's it went down over the past 20 years, right? So we know now that in 1988, taxes were 30% higher than they are today. Remember I said earlier in the presentation, there's a reason I was using 30%, and this is why. Because right now in the real world, we are at a low tax environment. In 1998, they were 30% higher. So just 20 years ago, they were 30% higher. And that, unfortunately, is more on line with the average that was traditionally in the tax bracket. And we right now are fortunately in a lower bracket. Our brackets are lower, which leads us to think, hey, let's take advantage of these while they last. They may not last long, but that's just, my opinion. But right now we know that taxes were 30% higher in 1998 than they were here. So moving forward with that analogy, let's do it again, right? 64-year-old person, 25% tax liability, an IRA at $500,000, 5% annual growth, pretty standard. We're raising the tax bracket here. We say next year, but it could be at any year. It doesn't really matter. So you have 30. Let's say the tax bracket jumps from 25 to 32%. Let's see what that looks like. So in this scenario where the taxes go up in retirement, what does that look like? You could pay $265,000 in the RMD. That would be the new number. The taxes paid on the allocation when you move the assets, that number would obviously also go up. It could be as high potentially as $110,000. And what's passed along to the heirs? Potentially that could be taxed at over $200,000. So let's add all those up together. And yes, that is correct. Over the lifetime of this IRA, if taxes were to go up in the scenario we outlined here, you would be looking at paying more in taxes than the initial value of the IRA. So let's do the same exact scenario, changing tax liability in the future. What does that look like if we were to do a Roth conversion? Well, we know taxes right now, right? That's the nice thing. We know what they are right now. So we know that this is the same as before. We know it's $25,000. And we also know that there's no growth on the tax on the growth. There's no tax on the value at time of death. So we are fortunate here in this scenario that our taxes don't change because we've taken care of all the taxes now. They're done. So, we showed this before, right? Over time, you could have owed $450,000, and that is if and only if taxes don't change. Or if you take care of it currently, take care of it now, your tax bill could be as low as $125. But we just went over what happens if they go up at some point in retirement. Then that could potentially be almost $580,000 in tax. But your current tax doesn't change, right? You're still at that $125,000. We don't know. We don't know where taxes are going. It could be higher, it could be lower, whatever. But we are trying to make sure you are able to plan for this, that you see what the potential risk could be here, because it's big and I think it's unspoken about a lot. Not many people talk about what could happen here. And I love this quote as we're getting ready to finish up here. I love this quote by Leonard Hand, who was an appellate court judge for a long time. He said, there are two systems of taxation in our country, one for the informed and one for the uninformed. My purpose today was to put you in the category of the informed. I hope we did that, or at least I hope we got you thinking about, I need to be more informed because I never even thought about this before. So how can you be more informed? And how can we, obviously because we're here today, how can we help you do that? Well, let me start off by saying we've done this in the past. We do this all the time, and we've helped save our clients tons of money with different strategies to mitigate their taxes as much as we can. We talked about one strategy here as that example with the Roth conversion, but there are numerous things we can do. So what can you do to be informed? Well, there's a couple things. And what I'm going to do here is I'm actually going to come back on screen because we're pretty much at the end here. One of the things you can do is, if you're comfortable and you want to, let's have a conversation. Let's just have a 15-minute conversation, no strings attached. And when we do this, a lot of people just, walk away from this webinar with a couple questions. Well, how does this look? And talk to me again about this, and think just various short things. Let's have that conversation. Let's talk. Let's see if we can answer them for you, or we can set you on the right path. Also, I would recommend reading the New Holistic Retirement. It's a very short book. This is a lot of the stuff that we talked about here is based on with that group. I'm actually just looking around. I do have a copy of it right here for everybody. So if you're interested in reading this book, we can get it to you. You would just have to reach out to us and we want to have a conversation about your situation, and then maybe we'll see if that book can help you. Also, one of the things we can do if you have some immediate concerns or just want to see as you're planning, right? Because I'm one of those people, I want to see what it looks like. I'm thinking about it now, I'm planning for it now. We can run a lot of custom reports. We can take some basic information from you and tell you, like, based on these different scenarios, this is what you could potentially pay in tax. A lot of people have found that very helpful. We don't charge for that. That's something we do because you're on this webinar with us. So if you want us to do that, feel free. We'd be more than happy to help you. I will say this as we're getting ready to close here. Do something. Get informed. Let us help you. We don't charge for conversations. We don't charge for the book. We don't charge for the report, but it could give you a lot of good information and set you on the path. And if you need our help more specifically, obviously we'd be more than happy to work with you. I hope you guys found this valuable. Shoot me an email if you have any questions or any comments. Obviously, our disclosure is here. I'll tell you that if you question or have any questions about where these numbers came from and how we made this work, we'd be more than happy to send you that boring stack of information. Not a problem. Just feel free to reach out to us. I hope you guys found this valuable. I hope you take the opportunity to become informed and work through these scenarios. We're here to help you. We do anything we can. But in the meantime, have a great day. You guys enjoy. Thanks a lot for being with us. Bye.